Andrew Holland is Chief Executive Officer at Avendus Public Markets Alternate Strategies. Andrew, good to have you with us here. Thank you very much. Is there more downside, or do you think downsides are limited with upsides also kind of capped for now? What's your sense?
I certainly think the upside is capped at the moment because, again, when we spoke last time, I said it's quite messy out there globally. You got the yen at 150, you got the hawkish Fed speakers still saying that there could be one more rate increase. So, the story goes on. So that, that Goldilocks scenario that everyone's been hoping for kind of starts to wane into the background now as some of these, problems persist. And are not going away. So for our markets, we got the oil price has cooled off from where it was, but I still think because of that, the RBI, when it has its monetary policy this week, is going to be more hawkish. They might try and smooth it out, but they'll be hawkish because of inflation, and the rupee, as you can see, is also kind of weakening. Along with other emerging market currencies. So, the overall kind of outside of India is not looking great. And I think that's weighing on investors' minds, particularly for foreign investors, where they're seeing, obviously a good outperformance from India. It is the most loved market at the moment, and maybe just taking some of that some of those gains off the table from an overbought situation where we are. So, I think we're in that range between, I don't know, it's a wide range, I think, probably towards those lows of 19,000 and the highs of 20,000. And I think we're stuck there for a little while now. Maybe the catalyst next will be if some of the local elections are, more favourable, or as we go into next year as the general elections and optimism towards that starts to pick up in terms of momentum for the Indian index.
Mm-hmm. Andrew, hi, good morning. So to be here, since you brought up elections, let me ask you about that. Would you look at any sort of a play over the next 4 or 5 months till we get into election season full throttle? And if yes, what would that play be? More of the same? CapEx? So we've got the CapEx numbers for the, April to August period, along with the fiscal deficit data on Friday. And it's really roaring away. The numbers are speaking, right? So would you continue to be in areas like, defense, railways, wherever all this money is coming in? Or maybe would you look at consumer? Because the anticipation is that the government should start loosening up its purse strings, and that should help that part of the market as well, getting closer to the event. What would you advise?
It's also, it's very difficult to say what the government might do ahead of any election. So I'm not really playing into that theme of consumption because of elections, and haven't done over the years either. I think, what I was going to say is that the government capex, along with the private capex, will have that multiplier effect, and that's what's going to be the earnings momentum and the rising kind of earnings upgrades over the next 6 months to 9 months as you kind of head towards the elections as well. So I think that's the play I would have in terms of the overall India market. And whilst that target of 20,000 nifty still remains for me for March, I think you'll see a gradual rise, maybe past that as we head towards the elections, but also because of the earnings upgrades. I think you'll start seeing in the second half from say now onwards into March of next year. So the themes that you've talked about in terms of infrastructure and railways and defence have been themes we've been talking about for some time. So they don't go away. They're still going to have money spent on them. I think some of the companies have seen a rapid rise in their share prices. And again, if you go back to that kind of 2004, 2007 period, I think you'll find that most share prices rose on the back of order wins rather than execution thereafter. So that's probably the play you could continue to see in the infra stocks.
Hi, Andrew. Good morning. Andrew, what about the IT stocks? In the next few days, we're going to be getting the IT numbers that will be coming out. And I don't think the street is expecting anything, out of the box or any big positive surprise, that index and stocks out there have done really well. How are you positioned on the IT theme in particular?
No, I mean, I think with the IT theme, it's really a matter of what the commentary is. And again, we're getting mixed views on that. Accenture, I think, kind of highlighted some of the problems that are still out there. And I think there's a hope value that it's all okay and things will start moving ahead. And I think that was based more on what was happening in AI and a kind of pickup in the NASDAQ and those related stocks, rather than it's anything to do with the environment out there. So I'm not convinced that the IT sector is out of its problems yet, and we might see some more downgrades to earnings. That would probably be the time I'd be looking more seriously at the IT sector. But at this moment, I don't think there's any need to rush into it. It's defensive if you want to be defensive in a market which might be falling over the next few weeks. But otherwise, it's not going to give you that growth that you really want, it's not going to be a driver of the Indian index, that's for sure.
Okay, got that point. Andrew, let's talk banks. This has been one underperforming sector. So far, there's been the whole big bank rally has been missing. And maybe that also ties in with the fact that FIIs have not really driven this rally. It's been more driven by domestic money. In fact, last month, FPIs were net sellers in Indian cash equities. What's the prognosis as we look at the next couple of months? Do you see a catch-up play over here? And if so, how would you look at it? Because PSU banks still have had a fantastic trading month, but the larger names have been fairly range-bound. What would you reckon could be the way forward?
So I think as we come into the results season, there's two sectors which I think the market are going to focus in on, and one is IT, which you just talked about, and second is the banks. And I think the key is what the commentary will be about NIMs. Since HDFC and the brokers' reports about HDFC being more negative, I think the question mark now over, yes, you're seeing good growth, but it is at the expense of margins as well. And I think that's what the market will be looking at in terms of, can there be a next leg for the banking index? If there's any disappointment at all, then I think you'll see the follow through in terms of more selling in the sector. But for the time being, I think the jury's out. So we'll wait and see what some of these banks say. But when a sector should be doing well, and all of the factors are there, for it to be underperforming is telling you something that there's something that we're missing at the moment, and maybe it's all about NIMs.
All right, Andrew, but since you mentioned HDFC Bank, what's your view on HDFC Bank? The street is divided out there. One part believes it's the most juicy valuations that you have seen in the last few years, so you must get in. The other part of the street says no, for the next year or so, they're going to find it very difficult to grow on this large base. Return ratios are getting diluted, and NIMs as well are not looking up. So they said you'll have plenty of time for the next 12 to 18 months if you want to get in. What is your view on this bank?
Yeah, and so I think you could say that about all banks then, right? I mean, in terms of the NIM story, is it going to be a pressure for all banks? Is the inclusion of Geo into the financial world going to change things around again? So I think these are kind of question marks which are there. I don't think at the moment I'd be saying that any one bank is standing out. And so therefore, whether it's a juicy valuation or not, I think you can wait. I think let's wait for the results season, because I think that will tell us a lot more of what we need to do in this sector. Because, as I said, it should be outperforming. The economy is doing well. The bank's loan growth is doing well, but there's something that's holding back the banking sector. So I think that the story will be unfolding as the results come out.
Okay. Andrew, finally, let's talk about maybe, what do we call it, the elephant in the room or something else. There's 4.7% on the US 10-year yield, 107 on the dollar index. Till now, it's not hurt equities in too bad a fashion. I mean, US markets were down 4.5% in September. Our markets have, just been range-bound, flattish. So we've not really seen a big correction. But is that something that is still on the table, according to you?
Yeah, I mean, it worries me more and more with the factors which are out there, which are negative, whether it's from China to the yen, to higher rates or yields in the US, and the problem still, dogging Europe. At some point, it will come to a head, and I just think that the problems. Let's just take the US for example. I think. Consumers now have to, or the kids have to start paying their school fees or school loans for the first time. So that's going to eat into the discretionary spending there. And then you've got, commercial real estate is reeling a little bit under the higher interest rates, and you're seeing a lot of empty spaces there. And the regional banks still have these problems at higher yields. Their problems don't go away. It's just masked by the fact that the Federal Reserve is helping them out. So all of this leads me to, if something cracks in any of these areas, the market's not ready for it. And there's no shorts in the market to really kind of help you. So the fall could be quite quick. And I think, I'm not saying it's going to happen straight away, but, the more we hold on to these levels with no kind of retracement, the more risky the market becomes because of these factors. The Goldilocks scenario is really not playing out. And I think the markets, we've seen, you said 4% in September, but it's 7% from the high that we saw, maybe in August. So you'd already seen some retracement, a big retracement. It's been slowly and a little bit more painful, maybe, there were the one-off kind of fall. But the 1% falls in the US market are becoming more, more noticeable over the past month and a half.
Okay, all right, Andrew, thanks so much for stopping by and filling us in with details on how do you see the market as well as individual sectors that we just discussed.